Stock market terms explained, Part 1, the basics. Welcome to Investing Insight, where we make the world of finance simple and easy to understand. In this video, we'll explore the basic terms you need to know before you start investing. By the end, you'll be able to follow stock market conversations with confidence. A stock is a share of ownership in a company. When you buy a stock, you own a piece of that business and can benefit if the company grows. A share is one individual unit of stock. If a company issues 1 million shares and you own 10,000, you own 1% of the company. Equity is another word for ownership. Stocks are sometimes called equities because they represent part ownership in a company. A stock exchange is the official marketplace where buyers and sellers trade shares. Famous examples include the New York Stock Exchange, Nasdaq, the London Stock Exchange, and the Tokyo Stock Exchange. A ticker symbol is the short code used to identify a company on an exchange, for example, AAPL for Apple, or TSLA for Tesla. A broker or brokerage is a licensed service that allows you to buy and sell stocks. These days, most investors use online brokers or trading apps instead of traditional firms. The bid price is the highest price a buyer is willing to pay for a stock. The ask price is the lowest price a seller will accept. The difference between the two is called the spread. When people talk about a bull market, they mean the market is rising and investors feel confident. A bear market means prices are falling and fear dominates. Think of a bull thrusting its horns upward and a bear swiping its paws downward. Volume is the number of shares traded in a given period. High volume means many investors are active in that stock. Liquidity refers to how easily a stock can be bought or sold without moving its price. Popular stocks of large companies are usually very liquid. Volatility measures how much prices go up and down. Highly volatile stocks can move sharply in a short time, creating both risk and opportunity. A market order tells your broker to buy or sell immediately at the best available price. A limit order lets you set the exact price you're willing to pay or receive. The order will only execute when the market reaches that price. A stop order, often called a stop-loss order, automatically sells your stock if the price falls to a level you choose. It helps limit potential losses. Margin trading means borrowing money from your broker to buy more stock than you could with your own cash. It can increase profits but also magnify losses. Short selling is when an investor borrows shares and sells them, hoping to buy them back later at a lower price. It's a way to profit when a stock's value drops. Day trading means buying and selling stocks within the same day, trying to profit from short-term price changes. Swing trading involves holding positions for several days or weeks to capture medium-term moves. Long-term investing means buying strong companies and holding them for years to benefit from growth and compounding returns. These are the foundational terms that form the language of the market. Understanding them will make it much easier to follow financial news and investment discussions. In the next video, we'll look at the people who make up the market, from retail investors to hedge funds, and how they interact behind the scenes. Don't forget to like, subscribe, and turn on notifications for more clear investing lessons every week from Investing Insight.